Okay, so let's jump right in. We're talking about the foreign exchange market. You probably know it as Forex. And, for the longest time, this was a place only for the big dogs. We're talking giant banks, huge financial institutions. But that's all changed, big time. Thanks to technology, it's now one of the most accessible markets out there for regular people, for individual traders just like you and me.
So, just to give you a sense of the sheer scale here, check out this number $2 trillion. That's not a year, that's the average daily turnover. It is, by a massive margin, the biggest, most liquid financial market on the entire planet. And when we say liquid, we just mean it's super easy to buy or sell, like instantly. It absolutely dwarfs the stock market. So, yeah, the opportunities, they're huge. But, and this is a big but, with that kind of opportunity comes some serious risk. And this is something we have to talk about right out of the gate. Check out this quote from author and trader Grace Chang. She estimates that over 90%, 90% of Forex traders lose their money. So why? What's going on? Well, a lot of the time it just boils down to not understanding the basics. So that's what we're going to do here. We are going to break down those fundamentals so you can really get a handle on both the massive potential and the real dangers of this market. All right, let's pull back the curtain. What is this global playground really, where all these trillions of dollars are flying around every single day? Okay, at its heart, Forex is just the market where you trade one currency for another. Simple, right? But here's the key thing to get. There's no central exchange. It's not like the New York Stock Exchange where there's a big building with a trading floor. Nope, it's totally decentralized. It's an over-the-counter market, which is just a fancy way of saying it's a huge, global digital network connecting banks, brokers, and traders all over the world. And this is where you can really see the revolution that's happened. I mean, it used to be a total old boys club. You needed a mountain of cash and all the right connections just to get a seat at the table. But today, if you've got a computer and a little bit of money in a broker account, you're in. You can trade right alongside the biggest players in the world, all with the goal of making a profit from those little currency wiggles. So what's the big deal? Why are so many individual traders flocking to Forex? Well, it's got some really unique advantages that you just don't find anywhere else. For starters, it's a true 24-hour market. It literally follows the sun around the globe. Starts in Sydney, moves to Tokyo, then London, then New York. So you can trade pretty much whenever you want. We already talked about the insane liquidity, right? You can get in and out of trades in a snap. Plus, and this is cool, you can make money whether a currency is going up or down. Transaction costs are usually super low, but the biggest, most powerful, and most dangerous feature of them all, it's something called leverage. Okay, so that brings up the obvious question, right? All these advantages sound amazing. A 24-hour market, low costs. So what's the catch? There's got to be a catch. And there is. And like a lot of things in the world of finance, the biggest advantage is also the biggest risk. Yeah, let's be crystal clear here. Leverage is a total double-edged sword. It's what lets you control a huge position with just a little bit of your own money. For example, a 100-to-1 leverage means for every single dollar of your own, you're controlling $100 in the market. Now, this can magnify your profits like crazy. But, and please listen to this part, this is the reason for that 90% failure rate we mentioned. It magnifies your losses just as fast and just as brutally. All right, before we get any deeper, we've got to learn to speak the language. Like any specialized world, Forex has its own lingo. But don't worry, it's actually pretty straightforward once you see it. So let's break down the essentials. First things first, currencies are always traded in pairs. And they have these three-letter codes you see here. So if you see EUR/USD, that's the euro versus the US dollar. When you make a trade, you're basically making a bet on which one will get stronger. You're always buying one and selling the other at the exact same time. Okay, so how do we even measure profits and losses in these tiny little price moves? We use something called a pip. A pip is just the smallest little step an exchange rate can take. For most currencies, it's that fourth number after the decimal point. Just think of it as the basic building block, the atom of a Forex trade. So what's a pip actually worth, like in real money? Well, that depends on which currency pair you're trading and how big your trade is. Let's just walk through this example right here. If you're in a standard $100,000 trade of the US dollar versus the Swiss franc, one single pip move is worth $8.19. So if the price moves in your favor by just 10 pips, that's almost $82 in your pocket. See? Once you get the formula, the math isn't so scary. This is another really crucial point, understanding the difference between investing and trading. They are not the same thing. An investor buys something, like a stock, and plans to hold it for years. They care about owning the asset. A Forex trader? Totally different game. They're in and out, sometimes in minutes, sometimes in days. They could care less about owning the currency. They are 100% focused on profiting from the price going up or down. And this is key. They live and die by their risk management rules for when to get out. All right, this brings us to our last section, and honestly, it's probably the most important one. Real success in trading isn't about the fancy software or knowing which button to click. It's about your mindset. It's about your strategy. This is where we're going to tackle that scary 90% failure rate we talked about. First off, you need to know there's no one-size-fits-all approach here. There's no single right way to trade. It all comes down to your personality, your schedule, you. You could be a scalper, jumping in and out of trades in minutes for tiny little gains. Or you could be a position trader, holding on to a trade for weeks or even months, trying to catch a huge market move. You gotta find the style that fits you like a glove. And now for what is, without a doubt, the #1 golden rule. This is absolutely non-negotiable. You must only trade with money you can truly afford to lose. This has to be risk capital. If losing that money would change your life for the worse, if it means you can't pay rent or buy groceries, you have no business trading with it. Full stop. Period. This quote really says it all, doesn't it? If you treat trading like you're just rolling the dice in Vegas, guess what? The house is probably going to win. The people who actually succeed, they treat it like a serious business. They have a business plan, they manage their money carefully, they keep meticulous records. They are professionals. So what's the big takeaway from all this? Well, our source, Grace Chang, boils it all down to what she calls the 3 M's of success. I want you to think of it like a 3-legged stool. The first leg is mind. That's your psychology, keeping your emotions in check. The second is money. That's your money management, protecting your account. And the third is method. That's your actual trading system. Now, what happens if you kick out one leg of a stool? The whole thing comes crashing down. And that's exactly what happens in trading. You can't just focus on finding the perfect method. You need all 3 to stand a chance. And so that really leaves us with a final question, doesn't it? We've seen just how huge this market is. We've seen the incredible rewards, but also the very real, very serious risks. We know that success really comes down to those 3 pillars: mind, money, and method. So the real question now is for you. How are you going to build a plan that addresses all 3?